Hey, this is attorney Elizabeth Potts-Weinstein. Today we're going to be talking about 6 strategies to reduce the tax burden on your LLC. So if you have a business, and specifically I'm talking about limited liability company businesses, but really these tips apply to most businesses, you were probably thinking about how can I pay less in taxes, especially if you're actually making a profit now in your business. You want to see if you can reduce that tax burden. One of the wonderful things about having a business, especially a business that is an LLC or corporation, is that you could do some sophisticated tax planning and take advantages of all these different ways that wealthy people and people with businesses can save on taxes. So how do you actually do that? And I'm going to go through 6 different strategies. The first one is actually the most simple and in some ways obvious, but a lot of people mess this up. And that is to just make sure you're keeping track of everything. You have all kinds of expenses that are mostly going to be deductible against your income. Are you actually tracking all of them? Are any of them getting missed? Do you not have the paperwork for it or the receipts or whatever you need to keep for that particular kind of expense so you can take that deduction? It's very common when people have a very small business, especially if they're just one person, that you can get kind of lackadaisical about keeping really good records. And if you haven't outsourced your bookkeeping or accounting to somebody and they're not like after you to get all that stuff, it's only you that you're accountable to. Very easy. Really here, I'm talking about having some kind of bookkeeping where you track these things. Now, if you have an LLC, you're already having to keep your bank account separate, which you should be doing, and you already should have some kind of bookkeeping. And this is just a reminder to make sure that you do that. So it literally could be on paper with a really simple business. It could be an Excel spreadsheet or some other kind of spreadsheet, a Google Sheet. It could be software that you use, or it could be a person that you hire or a company that you hire. Whatever you're going to use, you want to make sure that they're capturing everything. There's going to be expenses for your business that may not come out of your main account. It may be something that you use a personal credit card for because you forgot your business card. It may be something you paid cash for. You need to make sure you have receipts for everything and you track all those expenses. Number 2 is kind of related, and this is to make sure that you shift whatever expenses that you might be paying for personally, but really are business expenses, to the business and have the business pay for it and take the deduction. So what kind of stuff am I talking about? Some common things are, first, your mobile phone and your internet. If you work from home or work from, moving around in different places, you don't have a physical office outside of your home, then you're probably using the internet for your business for a fair amount of the time, and you're probably using your phone. Now, if you have a separate phone for work, then this makes it a little bit easier. But if you have just one phone, which is what I do, and you have just one internet, then you can keep track of the expenses that you're using for that on a percentage basis, and the percent that you use for business, you then can deduct, as opposed to the stuff that you use personally. Now, if you have something that's just dedicated just for business, that obviously makes it a lot easier. If you got audited, you would have to show how you came up with that calculation. And so you need to have some kind of log or tracking or something that you can give them to show them how you came up with those percentages. The next part of this is business use your car. Now, it just depends on the kind of business. I actually don't use my car for my law firm business, so it doesn't apply to me personally. But you may be using your car for your business. And you can keep track of the expenses, either the actual expenses of your cars using it for your business, or you can do a deduction based on mileage. And that's another deduction that you can take. Same idea here is if the car isn't owned by your business and you also use it for personal stuff, it needs to be based on how much you're actually using it for the business. And there are very specific rules about what applies. It doesn't apply to, like, if you're just driving from your home to your work, that you don't get to deduct that. It's more if, let's say you're working from home and then you're going out to the client's location, or you and the client are going in the car to a meeting, that's the kind of stuff where you might be able to deduct those miles or the actual expenses. The next thing to think about is education. I think this is a common thing for people to forget that classes they take, books they buy, events that they go to, seminars that they go to, and the transportation involved is also deductible, because it can be common to pay for that with your own money because it's just easier to like pay for that book on Amazon with your own money. But really, you bought that book on Amazon to read for your business, right? And so all that stuff can go on the business's credit card or debit card or however you want to set it up and get deducted on behalf of your business. Another common thing is interest on business debt. So sometimes what happens is someone will have a credit card that they're using for business stuff because you just started up your business and you end up using a personal credit card because you haven't even formed the LLC yet, perhaps, for all the startup expenses. The interest on that debt might be deductible by the business because it's a business expense. Now, right now it's on your personal credit card, so that's going to be something you're gonna have to really track. You want it to be a separate credit card than you use for personal things. You don't wanna commingle that stuff. And eventually you want the LLC to actually have its own debt and not have it be your personal credit card it's on. But it's a very common thing for people to do when they start up a business. And I can totally understand if you ended up doing that in the beginning. Interest on a business debt is deductible to the business if you can show that that is all business debt. Category number 3 is something that a lot of people think about, which is your home office. And home office, the issue there is that the use of that space has to be exclusively for your business. So this desk that I'm at, this little like space that I'm at, I would calculate what is the square footage of this office compared to the rest of my apartment or house. And then I can deduct all kinds of things, the rent or the mortgage payment or whatever it is, that percentage that is due to the use of the business versus the rest. It's easier to do this if like you have a literal office. Like I used to own a house where I had a separate freestanding office that was attached to the garage. So that was really easy to track the home office deduction because it was an office that was just for my business. I met with clients in there and everything. Versus now, I just have like a little corner of a room. So it's much more difficult to track the exact percentage and it being exclusive use because I can do other things. I actually am not currently taking the home office deduction for that reason because this is not an exclusive use space for me. But if you are able to set that up at your apartment or house to have a space that is exclusively used by your business, then you can take that percentage of square feet of the expenses for your house and your business can be paying for that and get that deduction. The next thing to think about, number 4, are personal deductions on the owner's personal tax return that are kind of about the business. So for example, charity donations. Your business may give money to charity. The business, an LLC that is taxed as a sole proprietorship or an LLC that's taxed as an S Corp, doesn't get to take charity things as a deduction. That isn't how that works. However, the business owner may be able to take that deduction on their own personal taxes. It all depends on what the current rules are for charity donation deductions and where that is on your tax return. Right now, you actually, whether or not you may have to itemize expenses because these are the kind of laws that change all the time. But charity donations, childcare and dependent care expenses, another thing that may be able to go on your personal tax return if you're paying for childcare so you can do this business. Retirement contributions, this is a huge one. So if your business is making a profit such that you can pay yourself enough to live and you have some extra, putting money into retirement, that is going to be a way for you to not exactly not pay taxes, but to defer paying on those taxes. Now, when your business is new, you may be better off putting money into a Roth where you do pay taxes on it, but then you don't pay taxes on it later. It really depends on your current tax bracket and your overall finances, exactly what makes sense to set up. But when you own a business, there's a lot more money that you can put into a retirement plan versus just like an IRA. The next thing in the personal tax return is for healthcare expenses. Now, for certain kinds of healthcare expenses, they have to be itemized, but self-employment premiums are on a different line. So I know this is kind of getting into the weeds a little bit because these are the kind of laws that change all the time. But if you're not covered under a spouse's health insurance, you may be able to deduct those premiums in a place that isn't have to be itemized. It can be just part on your regular part of the tax return. And the thing is with all these things, it really depends on your overall tax situation. Do you also have a day job? Are you married? Does your spouse work? There are so many things that can go into this, but when you have a business, a lot more of these kinds of things are going to apply to your particular situation. Number 5 is when you buy stuff for your business, you may be able to either depreciate the cost of that stuff and take a little bit of a tax deduction each year, or take the whole tax deduction at once. So when I say stuff, I mean a phone, a laptop, a camera, a microphone. I mean if you buy any sort of physical property thing. How it works is that you used to have to just depreciate everything, which meant that there was like these tables that said, oh, this thing over the period of 3 years loses its 100% of its value over 3 years. And so you take a third of how much you paid for it deducted each year. This thing is 7 years. This thing is 27 years. I think it's 27 years for like a roof on a house. Everything has its own depreciation calculation. But there's special rules that if your income is under a certain amount and various other ways it qualifies, you may be able to take the whole deduction in at once. And those are 2 main rules. One is a de minimis rule. So it's under, as of right now, $2,500. I'm sure this will change in the future. Then you can just take it, because the idea is like, look, we're not going to depreciate things that are under $2,500. So a lot of computers, some cameras, phones, these are things that, some inexpensive printers, there's a lot of kind of smaller items that they'll just let you take all at once. Now there's another rule called Section 179, and that you can take up to $1.08 million, but up to the amount of your income. And there's certain things that don't count there. It's not real estate stuff, it's not cars, but typically, I think a lot of times people take that, it's equipment and things like that, but huge $1 million amount of things you can take all in 1 year, up to the amount of income that you have. I think what happens is then you can push out the rest of it over future years. You'd of course always want to calculate, does it make sense to take that versus doing the depreciation? It may make sense in some cases to do the depreciation instead. This is the kind of thing, if you have $1 million of expenses, you would want to hire a tax person to do this calculation for you and see which way it makes sense. The 6th thing, which is kind of the biggest, is you can have your LLC elect to be taxed as an S corporation. This is one of the largest tax savings potentially that you can have for your business. It's not the right thing for everyone, because in the beginning, the tax savings isn't enough. So why is that? When an LLC is just taxed like a sole proprietorship, which is the default if it's one person, then your taxes are fairly simple. It's like on your regular tax return with the IRS. In some states, you may have a little bit extra reform, but it is something that you could use, one of these software things to do that for you. You don't have to hire someone necessarily. I'm not going to ever discourage you from hiring a tax person, because that can be a great way to save taxes. But you don't necessarily have to. But if you have an LLC taxed as an S corporation, once you get into the world of S corporations, I recommend that almost everybody hire someone to do their taxes, because it just becomes a lot more complicated. There are a lot more rules. And so once you're paying someone to do your taxes, you have to factor in that if you're paying someone $1,000 or $2,000 or more to do all that tax stuff, plus you have a lot more paperwork to do generally, and you have to do payroll, which we're going to talk about in a minute. So you're paying all these other people to do things. You have to be saving at least $1,000 or $2,000 or something on taxes to even break even. So you don't do this necessarily in year 1, but as you're making more money, you will save. Typically, where the difference is somewhere between making a profit that you pay yourself of $50,000 and $100,000. Somewhere in there is where it's going to make a difference. And here's how it's going to work. Here's how it's going to make a difference. Is that, let's say you made $100,000 profit in your business. If you're being taxed as sole proprietorship, that $100,000 gets paid to you, and self-employment tax gets taken out of it, income tax gets taken out, Social Security, FICA, all that stuff gets taken out of that entire $100,000. But if you have an LLC tax as an S corp, you put yourself on payroll and maybe pay yourself $50,000 or $75,000 a year on payroll, and you have to actually do that payroll, by the way, and pay yourself if you're working in the business. And that would have Social Security, FICA, just like a normal paycheck. But then the other $25,000, let's say, you just pay yourself as a distribution, and it only has income tax. It doesn't have self-employment tax on it. So you save a lot of money on taxes. The next thing that might work for some of you is you can have the S corporation pay for your health insurance. Now, whether or not that makes sense really depends upon your particular situation. A few years ago, I had my S corporation pay for my health insurance, but then I priced out what it was going to be for me to get health insurance directly from Cover California here in California. And it was actually cheaper, even including the deduction, because my corporation just got different quotes. I think it's because I'm the only employee, so I wasn't getting a group policy. It's different if you have 10 employees, you're going to get a group policy, and then you will hopefully get a better deal and it'll be less expensive per person versus an individual going out there and getting it from an S corporation. I found that it was a better thing to go get it directly. I got a better policy. You have to run those numbers. You have to run it for what the health insurance policy is going to be, what the health insurance policy is going to cost, and then also, of course, where the tax deduction is going to be. The last thing is retirement savings. Retirement savings is different, and you can save a lot more money with an LLC taxed as an S corp. So you can have a solo 401k, you can have a SEP IRA. There are a lot of different options, and you'd have to look at what's available as of the time that you're watching this video and what's possible for you to do, how much money you have, whether or not you have employees. There are many factors that go into what actually makes sense financially, but you can save a lot more for retirement versus just putting money in an IRA. And then of course, if you're saving money for retirement, that's deferring the taxes. You will eventually have to pay taxes on that, but you'll pay taxes on it when you theoretically will be in a lower tax bracket, and also it will just literally be the future versus paying taxes on it now. Again, this is Attorney Elizabeth Potts-Weinstein. If you found this video helpful, hit the thumbs up. If you have any questions about what we talked about, feel free to post them below. Subscribe for more videos like this. And if you want to connect even further, you can join the Discord, sign up for the Patreon. Links for that are below. Thanks a lot for watching. Bye-bye.